Hello everyone. In this last chapter we're going to discuss cash flows. Alright, so we've worked through all of our financial statements up to this point. We worked through the income statement, another statement called the retained earnings statement. We also worked through the balance sheet, which is the snapshot statement as of a given point in time. And lastly, we're going to work through the cash flows statement. The cash flow statement is simply a way for the readers of the financial statements to see all of the cash inflows and all of the cash outflows for the year. Ultimately, what it does is it gives you the middle point of the cash account. How did it start? How did it increase? How did it decrease? And what did the cash account end with? So we have to take this cash flow statement and divide it into different sections. There are three different sections of the cash flow statement. The first section is the operating section. And the operating activities basically include all of the cash effects on continuing operations. Effectively, what it does, it shows the cash effects, both the cash inflows and the cash outflows, that really affect current assets and current liabilities, if you will. All the receivables and inventory, prepaids, as well as the accounts payable, the wages payable, things of that nature. So basically the cash receipts, in a nutshell, come from collections from customers, interest and dividends, and other receipts from operations. In regard to cash payments, the biggest cash payments are those payments to suppliers for merchandise, and of course payments to employees for the payroll, paying of interest and taxes as well. Those are the main operating items. All right, and the second section is called investing. The investing activities involve all of those activities that affect your long-term assets. So that would basically be your fixed assets, your intangible assets, and any long-term investments that we have. The cash receipts, in a nutshell, are those from selling these long-term investments and these fixed assets, as well as any cash proceeds from collecting principal amounts on long-term loans. All right, loans receivable. Cash payments if we buy fixed assets or buy intangible assets, and amounts paid to borrowers when we actually loan people money. Okay? So those are your investing items. And lastly, the last section is called financing activities. The financing activities are basically any cash flow activity that affects long-term liabilities and equity accounts. Typically, the cash receipts would be proceeds from long-term borrowing, as well as cash receipts from owners. For example, if someone buys into the company for the first time, or if we issue treasury stock, cash payments, that would be for dividends to those owners, or when we pay back our liabilities. All right, so that's kind of the breakout of the three sections of the cash flow statements. Now, when we talk about cash, we're talking about cash and cash equivalents. Basically, you know what cash is, and the cash equivalents are basically anything that is so short term where they have a maturity date of 90 days or less, the original maturity date of 90 days or less, money market funds, T-bills, and the like. These are all going to be included in this cash section. All right, now, the reason why it's more difficult to do a cash flow statement with accrual accounting is because we record revenue and we don't necessarily collect cash at the same time. We also record expenses, and as you understand with accrual accounting, we record those expenses when we incur them, regardless of when we pay for them. So the reason the cash flow statement takes a little work to prepare is because the actual cash inflows and outflows may be different in a different period than the actual recording of the revenues and expenses. So to start with, to do the cash flow statement, we're going to need our income statement. We are also going to need a comparative balance sheet. basically a balance sheet at the end of last year and a balance sheet at the end of this year. In addition to these two statements, the income statement and a comparative balance sheet, we're also going to need to look at some detail of some ledger accounts for the current year. That's going to come in handy as well. Okay, so the first piece of information, the income statement. We can see here from the income statement that we have total revenues and gains of $940,000. That represents the net sales of $900,000. We have some interest and dividends, $3,000 in dividends, $6,000 in interest. And we have a $31,000 gain on the sale of the fixed assets. Now, what are our cost, expenses, and losses? Well, we have cost of goods sold of $500,000. We have operating expenses of $300,000. And you can see in brackets here, $40,000 of it actually is depreciation. $35,000 in interest expense. And we have a $4,000 loss on marketable securities. And lastly, we have income tax expense of $36,000 to get us to a net income of $65,000. Here's our comparative balance sheet. You can see we're comparing 2017 versus 2018. Now, our job of the cash flow statement, and you can see me circling it with my cursor here. See the first line, cash and cash equivalents? We need to explain how cash actually increased from $20,000 at the end of 2017 to $55,000 at the end of 2018. It increased a total of $35,000. Our job is to figure out how that happened. Okay, so once again, 3 sections: operating, investing, and financing. We're going to do the operating section first. And once again, the operating activities is basically to account for the cash flow for normal everyday operations. In other words, what were the effects of the current assets and current liabilities? Okay, so looking at the current assets and current liabilities, this is what we find out. And we're going to go through it bullet point by bullet point here, but it's backed up from the income statement, the comparative balance sheets, and some additional information. So first of all, on the comparative balance sheet, we saw accounts receivable increased by $30,000 from the end of year 1 to the end of year 2. Dividend revenue is recognized on the cash basis. All right. Interest revenue is on accrual basis. We had an asset called accrued interest receivable, and the comparative balance sheet said it decreased by $1,000 from the end of year 1 to the end of year 2. Inventory increased by $10,000. Accounts payable increased $15,000. Once again, I'm getting all of this from the comparative balance sheet. During the year, prepaid expenses increased $3,000 and accrued expenses decreased $6,000. Let me just show you as an example. Let's look at the prepaid expenses. This is what I'm talking about. See the prepaid expenses? I'm circling it here at my cursor. The end of 17, it was $1,000. The end of 18, it was $4,000. So when we say it increased $3,000, that's what that $3,000 is. The increase from a $1,000 to the $4,000. Okay? And the accrued expenses decreased by $6,000. What is that? It's this line item right here, down here. I'm circling it with my cursor. It was $9,000 at the end of 17, and it was $3,000 at the end of 18. It was a $6,000 decrease. So in any event, I'm not making these numbers up. They're coming directly from the comparative balance sheet. Okay, interest payable increased $7,000 from year 1 to year 2, and income taxes payable decreased $2,000. Okay, now we actually looked into the marketable securities, which is the investment account. It's an asset account. And when we look at the detail of the ledger, we see that there are a bunch of debit entries of $65,000 during the year, which represents the cost of what we bought. Think about it. When your marketable securities account increases, that means we are buying marketable securities. And there are $44,000 worth of credits. Now, the credits mean that the marketable securities were sold. Now, the $44,000 represents our original values that were sold. Okay, $44,000. And that is the amount that we're going to say is sold. Notes receivable, when we look at the detail, we see debits of $17,000. That means we let people borrow $17,000 worth, cash loaned by the company to borrowers. And we see $12,000 worth of credit entries in the notes receivable ledger. The credits to a note receivable means people paid us back. Fixed assets increased by $116,000 for the year. All right, during the year, the company borrowed $44,000 and paid back $55,000. We know this by looking at the note payable account. We see credits of $45,000, that's the borrowings, and we see repayments of $55,000. Those are the debits. The company issued bonds payable for $100,000 cash. I see that by looking at the bond payable account, the credits. Company issued 1,000 shares of $10 par value capital stock for $50 per share. I know this by looking at the common stock account as well as the additional paid-in capital account. And lastly, cash dividends of $40,000 were paid during the year. I see that in the dividends account. So once again, all of this information is gathered from the income statement as well as the comparable balance sheets. So this is all the information that's going to help us put this cash flow statement together. All right, first, the operating section. The first operating cash inflow is called cash received from customers. The cash received from customers, we are going to start with sales. The sales number comes directly from the income statement. That was $900,000. But what we need to do to convert this sales to cash flow is we need to take a look at accounts receivable. If accounts receivable decreased, that means cash flow increased. Hopefully that makes logical sense to everybody. If your accounts receivable decreased, what does that mean? That means we got additional cash flow from our customers. So in this case, accounts receivable, if we go back to the comparative balance sheet, the accounts receivable actually increased. That means we're selling, but we're not collecting. If the receivable is keeping on increasing, that means the cash flow is not there. So for the increase in accounts receivable, we have to subtract it out. If the accounts receivable decreased, we would have added it to the sales. But here we have to back it out. So cash receipts from customers is $870,000. It's the $900,000 in sales less the increase in the receivable. Okay, so you got to think of some logic here. Another way to think about this, and this helps some students, you can use what's known as the T account method. So draw T accounts for all these accounts. Now, if I told you that accounts receivable increased for the year, that would mean the accounts receivable was debited during the year. So when you're preparing a cash flow statement, whatever happens to one account, the opposite is happening to cash. So if accounts receivable is being decreased, if it's being increased with a debit, that means a credit is happening to cash. Well, a credit to cash is a decrease. That's why it's subtracted out. This is called the T account method. Okay, next, interest and dividends. Well, the interest received, this will be a cash inflow. We're going to start with interest revenue, and that number comes straight from the income statement, $6,000. Now we go to the balance sheet and we look at this asset called interest receivable. Well, interest receivable from the end of year 1 to the end of year 2, it actually decreased. If the receivable decreased, that means cash increased. We collected it. Receivables decreased with a credit. That means cash increased with a debit. So we're going to add the $1,000 to the $6,000. We get $7,000. Dividends, as we said, is already on the cash basis. So the dividend revenue of $3,000 we see on the income statement is the same as the cash inflow. So when we add interest and dividends, cash flow wise, it comes to $10,000. Next, we're going to talk about cash payments for purchases from our vendors. We're going to start with cost of goods sold. This comes from the income statement. So if you go to the income statement, you're going to see a cost of goods sold of $500,000. Now, just because it's a cost of goods sold does not necessarily mean that is everything we paid for. We got to take a look at the changes in inventory as well as the changes in accounts payable on the balance sheet. In addition to the cost of goods sold, we see that inventory also increased from the end of year 1 to the end of year 2. Inventory increased by $10,000. All right, so not only did cost of goods sold cost us $500,000, the inventory cost us $10,000, the increase in inventory. So that means we purchased $510,000 worth of merchandise. Now that's what we purchased. Now we need to actually adjust that to cash flow. And to adjust the purchases to cash flow, we need to take a look at the accounts payable account. Well, the accounts payable account from the end of year 1 to the end of year 2, if you go back to the comparative balance sheet, it said that the accounts payable increased. If accounts payable increased with a credit, that also means that cash increased with a debit. Cash increases, and now what are we trying to figure out here? We're trying to figure out cash paid. So that needs to be subtracted, the $15,000, from the net purchases to get you cash payments. Now, if accounts payable decreased, that means we made additional payments above and beyond what we purchased, and it would have been added. But in this case, accounts payable increased. All right, that means cash also increased, and for cash flow purposes, that is a negative if we're trying to figure out cash paid. Now expenses. Let's take a look at the expenses above and beyond just for merchandise. So cash payments for expenses. We're going to start with expenses on the income statement. If we add up all the expenses on the income statement, outside of cost of goods sold, of course, it comes to $300,000. Now included in that $300,000 are expense items that have nothing to do with cash flow, namely depreciation. Depreciation is an expense, but it never relates into a cash outflow. So what we need to do is we need to back out those non-cash expenses. So expenses on the income statement are $300,000. Subtract out the non-cash expense of $40,000, you get a subtotal, in this case $260,000. But what we need to do is now we need to adjust that $260,000 to cash flow. Did we pay for the full $260,000? Well, there are two things we need to take a look at on the balance sheet. The first is the asset called prepaid expenses, and the second is the accrued liabilities. All right, looking at the balance sheet, we see our prepaid expense from the beginning of the year to the end of the year. It actually increased to $3,000. If the prepaid expense increased, that means cash decreased. And if I'm trying to figure out cash payments, I'm going to add that $3,000 in. Now accrued liabilities. From the beginning of the year to the end of the year on the comparative balance sheet, accrued liabilities actually decreased $6,000. Well, if accrued liabilities decreased with a debit, that means cash also decreased with a credit. And that's what we're trying to figure out. We're trying to figure out cash payments. So the $6,000, trying to figure out cash payments, then we're going to add it to it. So the subtotal plus the $9,000 in adjustments gives us our cash payments for operating expenses. All right, putting it all together, cash paid for merchandise, which was from a few slides ago, we said was $495,000. Cash payments for operating expenses, as we stated on the prior slide, $269,000. That gets us a subtotal cash payments to suppliers and employees, total of $764,000. Okay. Now let's move on to interest and taxes. Start with the income statement. For interest, that's interest expense. I also see an interest payable on the balance sheet. From the beginning of the year to the end of the year, the interest payable actually increased from the beginning of the year to the end of the year. If the payable increased, that means cash also increased. And if I'm trying to figure out cash outflow, that means I need to back it out. So interest expense is $35,000, but the liability increased $7,000. That means we only paid $28,000 of it. That is the cash outflow. Now income taxes. Starting with the income statement, the income tax expense was $36,000. But I go over to the comparative balance sheet. I see a line item income tax payable. It decreased from the beginning of the year to the end of the year. If the payable decreased with a debit, that means cash also decreased with a credit. The cash decrease is added to the income tax expense to give you your total payments, $38,000. And putting it all together, finally, here's the cash flows from operating activities. Cash received from customers of $870,000, interest and dividends received of $10,000. That gives you cash inflows of $880,000, and the cash outflows, as we stated, the cash paid to suppliers and employees came to $764,000. And on the last slide, we saw the interest paid was $28,000 and the income taxes paid was $38,000. For a total of $830,000, subtract that from the cash inflows of $880,000, we get net cash flows. It's a positive $50,000 from operating activities. Okay. Once again, if you really take a closer look at it, it's really everything that affects current assets and current liabilities for the most part. Now let's move on to the second section, and that is the investing activities. And the investing activities are basically everything that affects your fixed assets, your long-term assets. So your fixed assets, your intangible assets, your longer-term investments. All right, including any money that we let people borrow. Okay, so first we're going to take a look at our investment account called marketable securities. We're finding debit entries of $65,000. That means those are the items that we purchased. So purchases of marketable securities, $65,000. That's a cash outflow. That's why it's in brackets. Now we look at the credits in the marketable securities ledger, and we see total credits of $44,000. All right, that is the amount of investments we sold, $44,000. However, that is not the amount we actually received. All right, even though $44,000 were the credit entries, if you take a look at the income statement, you saw that there's a line item called loss on sale of securities of $4,000. So even though in the investment account, the asset account, I'm showing credits of $44,000, yes, those were the investments that we sold, but we sold it at a $4,000 loss. That means the cash flow is not $44,000 but $40,000. So you got to be careful there. It's not only simply taking the credit, you have to look as if we sold it at a gain or a loss. Okay, next, let's take a look at our loans receivable. All right, we take a look at that notes receivable or loans receivable ledger account, and I see the debit entries come to $17,000. All right, if I increase my loan receivable with $17,000, that means we loaned out that money. That is a cash outflow, negative $17,000. Looking in that loans receivable account, I count credits, total credits of $12,000. Well, if I credit the receivable, that means that I've collected cash, right? So I'm going to increase the cash flow for $12,000. All right, and next, fixed assets. All right, we take a look at our fixed assets. We have our land, our buildings, our equipment, our vehicles, and the like. And we take a look at the details of those accounts. And taking a look at it, I add them all up, and it looks like the debits were $200,000. That means I purchased $200,000 worth of these plant assets. But when I take a closer look, out of the $200,000, only $160,000 of them were actually paid in cash. The other $40,000 I actually issued a note payable for them. So for cash flow purposes, I need to take the difference between the purchases of the assets are $200,000 less the note payable that was entered into. So the cash paid is $160,000. Now looking at the credit side of the fixed assets, I take a look at the credit entries and it looks like $44,000. of credits to the fixed asset accounts, those are the assets that were sold. But that doesn't necessarily mean we got cash flow for $44,000. Just like when we sold marketable securities and we saw that we sold them at a loss, I got to take a look at the fixed assets. And going to the income statement, I won't go back there, but going to the income statement, I see that those assets were on the income statement. I see a gain on the sale of fixed assets of $31,000. So even though the book value of what I sold was $44,000, I sold it at a $31,000 gain. That's a total of $75,000 proceeds, cash inflow from the sale of fixed assets. Putting it all together, this is what the investing section of the cash flow statement looks like. We purchased marketable securities of $65,000. That's why it's in brackets. It's a cash outflow. We got proceeds of $40,000. We made loans of $17,000. That's a cash outflow. We collected on those loans of $12,000. Cash inflow. We bought fixed assets of $160,000 in brackets, cash outflow, and we sold fixed assets for $75,000. You add it all up, this is a net cash outflow from investing. That's why it's in brackets. All right, and last but not least, the financing activities. The financing activities are typically all of that activity that affects long-term liabilities and the equity accounts. So one of the long-term liabilities, the note payable, if we take a look at the note payable accounts, I see that there's a bunch of credits totaling $45,000. All right, that represents the proceeds from borrowing. All right, I also see net debits of $55,000. Well, when I debit the note payable, what does that mean? That means you're paying it back. So that's a cash outflow. So we have cash inflows and outflows from borrowing. All right. Next, let's take a look at the bonds payable account. Bonds payable looks like it increased $100,000. That means we issued bonds. It increased with a credit. So that means we have a cash inflow of $100,000 for that bond payable. And now we turn our attention to the equity accounts. I look at the common stock and the additional paid-in capital accounts. They went up a total of $50,000. That means our investors paid $50,000 into the business for new stock. And I look at the dividends account and I see $40,000 of dividends were paid. If there was a dividends payable account, obviously I would have to adjust that $40,000 for either the increase or decrease of the dividends payable. If the dividends payable decreased, I would have added to this $40,000 to try to figure out what the cash outflow is for dividends. If the dividends payable account increased, I would have decreased this $40,000 to get to the cash outflow for dividends. In this case, there was no dividends payable, so what you see in the dividends account is actually the same as the cash outflow. Putting it all together, we got proceeds from borrowing, positive $45,000 cash flow. The payments off the debt is negative $55,000. We got $100,000 when we issued bonds. We got $50,000 positive when we issued stock, and we paid out dividends. That is a cash outflow, negative $40,000. You add it up together, we have positive cash flow from financing activities of $100,000. All right, and at the end of the year, we can see you add up the three categories and we get a net increase of $35,000 in cash. If the beginning cash was $20,000, that means the ending cash was $55,000. Putting it all together, let me see. Can we put it all together? Let me go back. Nah, I don't have a slide that puts it all together, but if you add up the operating activities, the investing activities, the financing activities, you'll get this net increase in cash of $35,000. Add it to the beginning cash, and this is the ending cash number on the balance sheet, $55,000. The starting cash in the comparative was $20,000. All right, so what we just worked through was actually called the direct method of preparing a cash flow statement. Now, the direct method is recommended Although a lot of companies, actually the majority of companies, use what's known as the indirect method for a cash flow statement. Now let me show you. The difference, by the way, between the direct and the indirect method is only in the first section, the operating section. Investing and financing is exactly the same for direct and indirect method. The only difference is the operating section. So as a refresher, and we worked through this way back earlier in this presentation when we worked through the operating section, this is what we came up with, what you see on your screen right now. All right, cash received from customers, $870, interest and dividends of $10, and the cash payments to suppliers for interest and for income taxes. So we saw a positive $50,000 cash inflow, net cash inflow from operating activities using the direct method. Now I want to show you the indirect method. This is an alternative approach. And basically with the indirect method, and like I said, a lot of companies use the indirect method, it's as follows. Basically with the indirect method is you start with net income directly from the income statement. In this case it was $65,000. Now what you're going to do is you're going to add in non-cash expenses, in this case depreciation expense. You're also going to add in losses on the balance sheet. Okay, loss on sale of marketable securities, 4. So we start with net income. You're going to add back in the loss and the non-cash expenses. Then what you're going to do is you are going to look at the current assets and current liabilities. And like I said, use the T account method. Whatever happened to the current asset or current liability, the opposite happened to cash. So let's take interest receivable. It decreased during the year. If the receivable decreased, that means it was credited. That means the cash was debited. That's an increase. That's why it's under the add. Now the next two, accounts payable and accrued liabilities. These are both liabilities. They both increased. How does a liability increase? It increases with a credit. So that means cash happened the opposite, debit. What is a debit to cash? It's an add. It's a positive. Then you get your subtotal. Now we're going to subtract out the other side of the cash ledger. So accounts receivable, we saw from the beginning of the year to the end of the year, it increased. If receivables increased with a debit, that means cash decreased with a credit. Inventory and prepaid expenses, same thing. If you take a look at the comparative balance sheet, they both increased with debits. That means cash decreased with debits. All right, accrued operating expenses payable. All right, and accrued income taxes payable, they decreased throughout the year. How does a payable decrease? Well, they're going to decrease with a debit. That means cash was credited. They were also decreased. That's why they're all on the less side. And then lastly, gains. Gains are subtracted. The reason why is because we're going to account for them in the investing section, just like we did with the marketable securities. You get the same answer, $50,000. It's just a different presentation. All right. And there's a sheet over here. I would like for you to see it. Here it is. I highly suggest you take a look at this indirect method summary, slide 54. You can see it here. Once again, you start with net income and you reconcile it down to net cash for operations. And you do so by adding in the depreciation expense and the decreases in the assets and the increases in the current liabilities. You also add back losses. On the deduct side, it's the exact opposite. You're going to deduct out the increases in the assets and decreases in the liabilities. Right? And you also deduct out the gains that you find on the income statement. All right? This is something that you really should understand. If you can use that T account method, whatever happens to one of these current assets and current liabilities, debit or credit, the opposite is happening to cash. So you would know which side of the indirect method to put this on, either the add or the deduct side of the operating activities section of the cash flows statement. And I think I have one slide here so you can see a cash flow statement. Let me see. Yep, I'm not going to work through this one, but I just wanted to show it to you. Here is what a finalized statement of cash flows looks like. This is using the indirect method. You can see we start with the operating activities, start with net income, reconcile all the way down to net cash provided by operating activities. Then we have investing activities, financing activities. If you add the 280 plus the 5 minus the 290, you get a net decrease in cash of 5. If beginning cash was 50, that means ending cash was 45. And this is the amount that will agree with the ending balance sheet. So there's your tie-in to the rest of the financial statements.